Hey everyone, welcome back to Corporate Decoder, the place where we unpack the secrets hidden in plain sight within corporate filings. Today, we're diving into a document that is less about a company's performance and more about its potential to perform, specifically through a new sales strategy. We're looking at a Form 8K filing from NextCure, Incorporated. Now, an 8K is usually filed when there is some pretty big news that shareholders need to know about right away. This isn't a quarterly earnings report filled with tons of financial tables, but it has still got a story to tell about how this company plans to raise money. So, what is the big deal here? NextCure announced they've entered into an agreement to sell up to $14.5 million worth of their common stock. Think of it like this, they're opening a new sales channel to bring in more cash. This deal was made on the 19th of December 2025, and it is with a company called H.C. Wainwright and Company LLC. They're acting as the agent, which basically means they'll be the ones helping NextCure sell their stock to the public. The total amount they're looking to raise is $14.5 million. This isn't a fixed amount they're getting all at once. It is more like a credit line for selling stock, and they can use it as they need to over time. The stock they're selling is their common stock. Each share has a tiny value $0.001, which is pretty standard for many companies. This part is important. They're not saying they will sell all $14.5 million. It depends on things like what is happening in the stock market, how much their stock is trading for, and of course how much money they actually need. It gives them flexibility, but it also means there is no guarantee they'll get the full amount. To do this legally, they filed a prospectus supplement with the SEC. Prospectus is like a detailed brochure that tells potential investors everything they need to know about the stock being offered. This is a really common step for companies looking to sell additional shares. This type of sale is called an at-the-market offering, or ATM. It means they can sell shares directly on the stock exchange, like the Nasdaq Global Select Market, or through other trading methods. The price will be whatever the market is paying at that moment, or something close to it. It is a way to tap into the market's demand for their stock. Now, H.C. Wainwright and Company LLC, the agent, isn't doing this for free. They'll get a 3% commission on whatever money is raised from selling these shares. So if they sell all $14.5 million, that is about $435,000 for the agent. What will NextCure use this money for? The filing states it is for general corporate needs, working capital, and importantly, funding preclinical and clinical trials, and developing their product candidates. This tells us that NextCure is likely a company focused on research and development, possibly in the biotech or pharmaceutical space, and needs ongoing funding to advance its projects. This ATM is a way to fuel that pipeline. They also had a law firm, Sidley Austin LLP, give their legal okay or opinion on the shares they plan to sell. This is another standard step to make sure everything is on the up and up legally. The actual agreement details are available in Exhibit 1.1, which is the ATM agreement itself. These documents, while dense, contain all the specifics of the deal. Now let's look at the bigger picture here. This filing isn't about reporting past financial performance in detail, but it is a peek into the company's future strategy for raising capital for a company like NextCure. Especially if it is in a capital-intensive industry like biotech, having access to funds is critical for survival and growth. This at-the-market offering provides that flexibility. What does this mean for investors? Well, it means the company is proactively managing its finances. They are preparing for future expenditures, like drug development, which can be very expensive and uncertain. It is a sign that management anticipates needing more cash to move its projects forward. However, it also means potential dilution. When a company sells more shares, the ownership stake of existing shareholders can get smaller and earnings per share can decrease. So, while it's good they can raise money, existing investors should be aware that their percentage of ownership might shrink. The risk here is that the company might be raising money because it is burning through its cash quickly or has faced setbacks in its development pipeline. The general corporate purposes can sometimes be a catch. But the explicit mention of preclinical studies and clinical trials suggest a focus on R&D, which is consistent with a growth-oriented biotech. This ATM agreement is essentially a tool in their financial toolkit. It allows them to be agile in raising funds when market conditions are favorable, rather than being forced to raise a large sum at a potentially bad time. The success of this offering will depend on how the market perceives NextCure's prospects and the overall economic climate. In conclusion, this filing signals NextCure's intent to secure additional funding through an at-the-market equity offering. It's a strategic move to support their development pipeline. While it offers financial flexibility, investors should keep an eye on how effectively this capital is deployed and the impact of potential share dilution. The key will be whether the funds raised translate into tangible progress in their product development and ultimately a return for shareholders. That is our breakdown of NextCure's latest filing. What is your take on this at the market offering and what it signals for the company's future? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description. Thanks for watching. See you next time.